Welcome to the Stock Market Palantir. Today we are going to talk about Meta.
And the volatility we've seen in this name, across the fourth quarter of 2025 has been nothing short of extraordinary. We saw the stock trading wildly between the low to mid 600s and then challenging the high 700s. Specifically, I think we need to analyze that 3.4% stock pop that happened after that early December news. That was the event that managed to arrest a staggering 22% decline that started right after the late October earnings report.
Right. And that steep decline, that loss of nearly a quarter of its market cap in just a few weeks, was purely triggered by CapEx guidance. Management signaled, and not subtly, that capital expenditures would be, and I'm quoting here, notably larger in 2026 than the already staggering $70 to $72 billion projected for 2025. This brings us right to the central conflict that is defining Meta's valuation right now. This tension between Mark Zuckerberg's aggressive, I'd say generational commitment to building superintelligence, a massive, asset-heavy AI gamble, and the market's, immediate demand for margin preservation and capital discipline.
Precisely. The price action just screams tug of war. So the critical question for investors is this recent rally a true signal that the market finally understands and, accepts the long-term, very expensive AI strategy? Or is it merely a technical relief rally, driven by short-term budget concessions and just quick behavioral flips? I think that's the core tension we really need to illuminate.
Well, I'm going to argue forcefully for the former. I believe if this rally signifies a critical re-anchoring of value, it's based on Meta's necessary pivot into foundational AI infrastructure. The market is slowly, maybe painfully, realizing that this spending, this unprecedented level of capital expenditure, is strategic, it's defensive, and ultimately it's existential. This isn't optional for them. It's a cost of doing business at their scale.
That's a bold assertion. And look, while I recognize the strategic intent, I'm sorry, but I just don't buy that the recent stock pop is based on some sudden enlightenment about AI necessity. The timing, the magnitude, it all suggests otherwise. Let me tell you why. I think the positive price action is overwhelmingly a behavioral response to one single, highly symbolic piece of news in early December, that planned 30% budget cut to the beleaguered Reality Labs division. It was pure efficiency theater, and the market gave it a standing ovation.
Okay, but let's delve deeper into this necessity idea, because I really think the market has begun to grasp the true economics here. The reason Meta has to spend $70 billion and then potentially $100 billion annually later this decade is, well, it's simple: survival. Running the foundational models, the training, the inference, for a global user base of 3 billion people using third-party AI models from, say, AWS or Azure, it's just economically unfeasible. The marginal cost of running third-party AI at Meta's scale would lead to absolutely debilitating margin compression.
So your view is that the CapEx isn't an investment in a new product, but it's really a necessary shift from an operating expense to a capital expense, basically buying down future high OpEx costs?
Exactly. It's an integrated defensive strategy. And we have to remember this AI infrastructure build-out is fundamentally different from the 2022 metaverse spending spree. That was speculative, right? Built on future product adoption. The current AI spending immediately feeds the core business and lets them preserve the high margins of their advertising engine. You can already see this paying off in the robustness of Meta Andromeda, their new AI-driven ad architecture.
I will grant you that Andromeda is a powerful platform. We saw ad impressions up 14% year over year in Q3 2025, and the average price per ad was up 10%. That pricing power is directly attributable to the AI spend, no doubt. It's letting them overcome privacy headwinds with deep learning. The core ad business is still a beast. However, I have to return to the primary driver of the recent rally. The market simply needed a sacrifice. Reality Labs was a financial black hole that institutional investors were just screaming to have closed. When we talk about $70 billion in CapEx, that's an astronomical wager. The only thing that mitigated the shock of that AI bet was a commitment to cut spending somewhere else. Reality Labs reported a $4.4 billion net loss in Q3 2025 alone that pushed cumulative operating losses for the first 3 quarters past $13 billion.
But a 30% cut to a single division doesn't fundamentally change the company's $70 billion overall capital commitment.
It changes the narrative. That's the key. The 30% cut signaled a profound, symbolic return to the year of efficiency mentality that the street loved. This action provided immediate de-risking for institutional allocators who were scarred by the 2022 bloodbath. They don't mind the massive capex for AI if they feel management is finally serious about cleaning up the legacy speculative spending. It's a psychological de-risking event that allowed capital to flow back in, regardless of the frankly daunting fact that the underlying AI capex trajectory still points towards a $100 billion annual run rate later in the decade.
I see the power of that symbolic signal. I do, especially given the history. But if institutional capital is returning, that implies fundamental conviction about future earnings potential driven by the AI stack, not just, short-term relief.
I struggle to see fundamental conviction there. I see technical pressure being absorbed by opportunistic capital. I mean, while the fundamentals look strong, how did the market actually behave during that massive decline from October through November? Let's look at the mechanics, specifically where the trading volume went. My focus is on market structure and liquidity fragmentation. Data shows dark pool participation for Meta often exceeds 50% of daily volume. Now, for listeners who might be unfamiliar, dark pools are private exchanges that let large investors execute block trades away from the public eye. And what concerned many observers was that the off-exchange short volume ratio, so the proportion of trading volume marked as short sales happening off-exchange, it spiked over 54%. Specifically 54.35% on November 25th, right when the stock was hitting the low 600s. Retail investors often look at that and see nefarious price suppression.
That is such a common, deeply entrenched misconception in the retail community, and it's essential we clarify it. I see why that data point causes alarm, but let me give you a very different and I would argue more accurate perspective on that high short volume ratio, or SVR. While 54% SVR sounds incredibly bearish, in this specific context, particularly for a highly liquid mega-cap stock, this metric is frequently a leading indicator of strong retail buying pressure. When the stock dropped aggressively into the low 600s in November, commission-free trading apps saw this immense retail enthusiasm to buy the dip. And here's the mechanic. When a market maker who facilitates these retail orders doesn't have the inventory of Meta shares to fill an instant buy order, they are required to temporarily short the stock in a dark pool to facilitate the trade immediately. They then cover that short moments later.
So you're suggesting the high SVR reflects the technical necessity of market makers filling all that aggressive retail accumulation, not a true structural bearish wager by hedge funds?
Absolutely. We have to differentiate between short volume ratio and true short interest. Short volume ratio just captures the transactional mechanics. If structural bearish sentiment were high, we would see true short interest elevated, meaning funds making a calculated long-term bet against the company. But in fact, structural bearishness is low. Short interest is only about 1.39% of the float. The market mechanics suggest that the high short volume in dark pools during that November period was merely the plumbing needed to absorb strong retail demand. It was a sign of robust accumulation, not bearish conviction.
That's a crucial distinction that often gets lost in all the chatter. Okay, so if we move past the trading mechanics and look at long-term valuation, what supports the rally's sustainability?
Right. Let's pivot to the drivers of fundamental valuation. Regardless of the short-term noise and the capex shock, Morningstar still maintains a fair value estimate of $850. This implies the stock is significantly undervalued, even around $670. That gap alone justifies institutional accumulation. But beyond the multiples, consider the major regulatory tailwind that has fundamentally changed the risk profile. The November 2025 federal judge ruling that Meta is not a monopoly was tectonic. It removed a massive existential antitrust overhang, the threat of a forced divestiture of Instagram or WhatsApp. That was the primary non-fundamental reason why investors demanded a discount on Meta's multiple for years. The removal of that tail risk justifies a substantial multiple expansion, a re-rating, independent of the short-term capex worries. The market can now price the company on its core earnings power without that fear of a government-mandated breakup.
That's a compelling point about the antitrust risk removal.
which was, you're right, an enormous drag on valuation. However, let's go back to the behavioral risk that kicked off this recent rally. We agreed the catalyst was the Reality Labs cut, which led to an immediate flood of retail buying. The retail sentiment cycle just flipped so hard from despair, the whole zucked post-earnings narrative, to aggressive FOMO, fear of missing out, immediately after that budget cut was announced. Data from sentiment aggregators shows an extreme skew, with something like 93.6% of tracked retail positions weighted towards long positions in early December. This massive, quick swing suggests a highly emotional and transient buying wave.
Volatility and aggressive retail engagement are just inherent to this name, but institutional capital is focused on the long game, that 850 valuation target.
And while that institutional patience exists, this extreme retail bullishness often serves as a powerful short-term contrarian indicator. It can signal a potential top, particularly when the price is approaching a major resistance level. We're getting near that $700 level, fueled by enthusiasm that might be based more on a symbolic change than the full commitment to the capex. This short-term behavioral risk suggests caution is still warranted until the price can consolidate above that key psychological level.
So your concern is that if the stock fails to break out and hold above 700, the retail buyers who came in purely on this Zuck is listening narrative will just as quickly liquidate, creating a short-term ceiling?
Precisely. The magnitude of the retail commitment right now just makes the stock highly susceptible to a quick reversal if there's any negative news or a lack of follow-through on that efficiency promise. The market bought a narrative, now it needs execution. And before we summarize, we have to address one crucial piece of misinformation that continues to plague the retail discussion and potentially affects investor confidence. This persistent chatter about a reverse split. I just need to clarify definitively for our audience that Meta Platforms Inc., so ticker META, the parent company of Facebook and Instagram, has never executed a stock split or, crucially, a reverse stock split. Reverse splits are typically for failing companies trying to stay listed.
Ah, yes. I see why you bring that up. The confusion is rampant, and it's a necessary clarification. The origin of this myth stems entirely from conflation with a separate, completely unrelated entity, Meta Materials Inc., ticker MMAT. That company has executed multiple reverse stock splits, like a 1-for-50 split in April 2025 to maintain compliance. For Meta, trading at $670 a share, a reverse split it's nonsensical. It just shows the level of misunderstanding out there.
And that clarity is essential because those rumors are often interpreted by investors as a sign of underlying financial distress, which could spook confidence even when the fundamentals are strong.
That rumor clarification is essential. But I think the smart money in the market is actually focused on a completely different potential corporate action, one that acts as a true bullish catalyst, a forward stock split. While a reverse split is fiction, a forward stock split, say 10-for-1 or 20-for-1, is a legitimate and highly anticipated possibility for 2026. Meta is the only member of the Magnificent Seven that has never split its stock, with peers like Alphabet and Nvidia having already done splits to lower the share price and increase retail accessibility. The expectation of a forward split serves as a further implicit bullish catalyst. It would confirm management's belief in continued capital appreciation and allow a new wave of investors to engage more easily. It reinforces the idea that this stock is just too valuable not to split.
That's a powerful point. A split would be a very overt signal of management confidence in the future valuation, regardless of the staggering capex.
So, to summarize my perspective, the core volatility we saw was simply the market grappling with a necessary generational AI investment. The fundamental drivers, AI dominance proven by Andromeda's performance, a highly conservative $850 fair value estimate, and the crucial removal of the antitrust overhang, they all support a significantly higher price. The volatility in Q4 2025 merely created a buying opportunity, confirming that this is an environment that favors the patient investor who recognizes the necessary long-term AI infrastructure play.
I agree that the AI investment is likely necessary for long-term survival, and I'll acknowledge that the Reality Labs cut was a positive and essential signal of capital discipline. However, I have to reaffirm my primary concern. The volatility remains structurally high because of the sheer magnitude of this AI gamble. A $100 billion run rate commitment is just monumental. And the recent surge has been significantly fueled by transient retail FOMO, driven by a narrative of "Zuck is listening," which could quickly dissipate if that $700 resistance level proves sticky. While the fundamentals favor going higher, caution is warranted here until the behavioral froth settles down.
Ultimately, I think what we are watching play out in the price action is the market struggling to reconcile Meta's identity as it transitions. It's moving from a traditional, asset-light social media company to an asset-heavy, vertically integrated AI infrastructure play. The volatility is just the sound of that valuation gap being slowly and aggressively closed. And monitoring that transition remains the key challenge for investors moving into the new year.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.